What's up, strategic investors? We're here to bring you breaking news regarding cryptocurrency and macroeconomics in a simple way that's easy to understand. This is one of the most volatile periods of history in the last several hundred years. Economics and cryptocurrency has never in history been as important to understand as it is today. We're looking to build a community of some of the brightest minds in all of finance. Asset management is like a game of chess, and we're always looking to stay one move ahead of the competition. Subscribe to our channel to become a part of the most comprehensive upcoming communities in cryptocurrency and economics. So enough with that, let's get to the content you all came here to see. What's up, everyone? This is by far the most important video that I put out so far, and I'd argue that this is the single most important concept in economics to understand and to continue to monitor for the foreseeable future. This video is going to be centered around the debt problem that we are experiencing globally, and we will tie it back to our overall thesis as to what we expect from the economy over the next 5 to 10 years. We believe the government has a major debt problem and does not have a good way of solving it. When it boils down to it, they only have a couple choices that each have their own consequences to the economy. We are riding a thin line, and it's a slippery slope on either side of the fall. They are in a catch-22, and depending on what decision they make, it will have drastically different outcomes for asset markets. We believe there will be incredible volatility in markets during this time period. As I understand it, the English word crisis gets translated into two characters in the Mandarin language. One character translates to chaos or something of the sort, and the other represents opportunity. As the book The Fourth Turning suggests, we are entering into the crisis turning of this seculum. This opportunity only comes around literally once in a lifetime and shakes up the course of history in ways that practically no one could have ever imagined. Previous examples of fourth turning eras include, but are not limited to, World War II, the Civil War, and the American Revolution. But if one can navigate the chaos effectively, there is immense opportunity to be found. That is why we are honed in on these markets and have our eyes fixed on this macroeconomic concept, as it is the invisible hand that guides the markets in today's economy. We are getting to the point where a decision has to be made regarding this topic, and the outcome will forever be remembered as a major turning point in history. So with that, let's dig into the details. All right, so as we mentioned, we're going to be talking mainly about the debt problem that we are facing globally. And this is the UnitedStatesDebtClock.org, and they have all kinds of different metrics. It is an absolutely spectacular site to visit every now and again. And as you can see, our U.S. national debt has just crossed $30 trillion. You can also see down here that the U.S. federal spending is just about $7 trillion a year and going up. And then just under here, you can also see that the U.S. federal debt to GDP ratio right now is 128%. You can see the 2000s, nowhere near. 1980s, even less. 1960s, still nowhere near. But we will look at a time period in history where the debt to GDP was actually pretty similar to where we're at today. And it might also be worth noting that this was also a time that was considered a fourth turning. All right, so we've established that we have a pretty serious debt problem. So that brings the question, what is the solution to the problem? And that's honestly where things get pretty tricky. There's really not a single good solution. You really just have a choice between several pretty bad solutions. But if we come over here, we can see where the government is getting their money. And you can see that it is coming from tax revenue. We have income tax revenue, payroll tax revenue, corporate tax revenue, tariff tax revenue. But we will look at in future slides or web pages up here that there are many other taxes that they hit us with. So it is not limited to these four. But something to note now that we've talked about this is that our revenue, which means the money that we're bringing in as the United States government, is about $4 trillion. And as we noted before, we are spending just over $7 trillion. So we're spending nearly double what we're bringing in. So right here, you can see that every year, this is just setting us up to add another $3 trillion to this number. And the spread between this number and this number is actually growing. So that means that our national debt is actually growing at higher deltas the more that time goes. So now that we've seen that this is a pretty serious problem that we have in front of us, let's just quickly talk about how the government is able to get the money through a couple other ways. So we've seen that they do get it from tax revenue, but they can also get it from importing less than they export. So exporting more than we import, which means that we produce and we sell more goods and services to the rest of the world than we buy from them, which would mean that we're bringing in a lot more money into the country domestically. You can also get it from tariffs, but that is definitely not a significant enough of a source of revenue to really do much for the problem that we find ourselves in today. And you have organizations like the WTO, the World Trade Organization, that originated as the GATT, the General Agreement on Trade and Tariffs, which from the name, you can pretty much tell that they are against tariffs because it's an agreement on trade and tariffs. It's really to free up free trade globally and really reduce the use of tariffs. So there's political headwinds when it comes to tariffs also. And there was actually a pretty recent example during the Trump administration, if anyone remembers, his tariffs on China and how far the media ran with that. The last way that they can get it is through a secret tax called inflation. The key is that if they go the route of inflation, they have to make sure that the yield on their debt stays suppressed at a manageable level to where the inflation can actually erode the debt away. So when a government wants to issue debt, in our situation specifically, they do so in the form of a U.S. Treasury, and they take that to the auction and they sell a Treasury with a yield that needs to be repaid over the duration of the Treasury, and then they are able to get that money back in return, and that's how they raise money. So it's really important that the yield on that Treasury that they sold stays at a pretty low level that they are actually able to manage to repay over the term. Because if you print a whole bunch of money and just for sake of example, let's use the stimulus checks. You send the checks to people and they go out and spend it on goods and services, that's going to come back as, say, like a sales tax or something like that. They're going to get the money back through taxes because the more money you have, disposable income that you're able to spend on goods and services, that's more opportunity for them to collect more taxes. And that's how the inflation theoretically would actually be able to bring them in more revenue. So let's just use today for an example. Inflation is 7%, and Treasury yields, let's just use the 10-year for example, and I don't know the exact number for today, but it's about 2%, and that makes for easy math, so let's go with that. You take the 10-year yield, which is 2%, and you subtract inflation to get the real yield. So that's going to be a nominal yield of 2% minus 7% equals negative 5%. So you can see in this situation, someone that is loaning the government money is actually losing 5% purchasing power every year. The thing is it's pretty tough to keep the yields on the treasuries down. And that's where the Federal Reserve comes in with their quantitative easing. Their quantitative easing, they go out and they buy up a whole bunch of treasuries and they provide liquidity to the market so that the government can go out and issue more debt. So as long as the treasury market has a buyer, which would be the Fed, and the supply meets the demand, the rates really don't go up. The yields on the treasuries don't go up. So that's how we've gotten ourselves in a situation today where we have a negative 5% real yield on treasuries. And I forget the exact number, but going into the pandemic, I believe our debt to GDP was about 135%, give or take a couple percent. So you can see that within the last year, their strategy is already working. But the thing is they've only recovered somewhere between like 5 to 10%. And we're still at 128%. And we need to get down somewhere at least below probably 100%. As you can see, historically, we've probably had an average of quite a bit under 100% also. That would be a pretty good target for the near term. So my thesis really is that somehow, some way, they're going to find a way to continue producing an atmosphere of an economic environment similar to what we had seen from after the pandemic to going into 2021, midway through 2021, before they let the exemptions to the SLR expire and started talking about tapering, raising interest rates, and unloading their balance sheet. Because going back to what we just said, as they unload their balance sheet, that's going to provide supply to the Treasury market, which is going to create a supply-demand imbalance and provide a tailwind for yields to continue going up. And we just mentioned that's terrible for the problem that we find ourselves in today, and would pretty much mean that they're just causing a whole bunch of inflation for no good reason. All right, so that should touch all the bases for the basic concepts. We're going to go dig a lot deeper into the details of this. So with that, let's continue moving forward. All right, so just wanted to touch on this one more time. In 2021, the government collected just over $4 trillion in revenue. Where does this money come from? If you lived or worked in the United States in 2021, most likely your contributions are part of the $4 trillion. Federal revenue consists mostly of individual, corporate, and social insurance taxes collected by the people who live, work, or do business in the United States each fiscal year. All right, and let's move over here. All right, so this is a breakdown of the total federal spending fiscal year of 2021. As you can see, we spent $7 trillion, which we saw before. And you can see that $2.81 trillion was spent on Social Security, unemployment, and labor, and this made up almost 40% of the pie chart. And then come down here and we have Medicare and health, which is $1.61 trillion, or just over 22% of the pie. And then we have military, which is $773 billion and almost 11% of the pie. We're going to skip over education and come down here to interest on debt, which is $300 billion. Or $303 billion, just over 4%. And then we're going to come over here to veterans benefits, which is $256 billion and just over 3%. So these five, the veterans benefits, the interest on debt, the military, Medicaid and healthcare, and Social Security and unemployment and labor. So all of those fall into three major categories, which are entitlements, defense spending, and interest on debt. So the entitlements portion is made up by Social Security, Medicare and health, and veterans benefits. The defense spending is made up by the military portion, and the interest on debt is this portion over here. So all three of these categories, if you reduce the spending in each of them, it would put massive political tension on the world. You know, if you cut someone's Social Security that you've promised them their whole life, or if you cut someone's health care, you know, if you have a family member that's on health care and you cut it and it's life-threatening, you know, how would you feel about that? Or if you cut defense spending, considering all the things that are going on around the world at the moment, all the tension, you know, that would probably be political suicide also. And if you don't pay the interest on your debt, you know, if you just start defaulting on loans that you've made to other countries or whoever it may be, you know, that's a real bad thing when you're the world reserve currency, because treasuries are pretty much just deferred dollars, because all it is a derivative that says that they'll pay you back dollars in the future with interest. So really, interest on debt is just deferred dollars. If you're not following your commitments on your interest on debt, that really sends a signal to the rest of the world that the US dollar probably has some reconsideration that needs to happen. So if you add up those three categories and those five sections of the pie chart we looked at, it comes out to be $5.74 trillion, which is still well over our revenue that we're bringing in every year as a government. So we can even do the math really quick just to see. So we'll divide this by 4.05, and that's showing that just these alone are 141% of our revenue. And it's going to be really important to note that the majority of this spending is actually entitlement spending. So entitlement spending is a commitment to pay someone something that isn't necessarily money, like healthcare, right? You're not guaranteeing to pay someone $1,000 a month for healthcare. You're guaranteeing to pay for their surgery when they need it. So if the price of surgeries goes up with inflation, so does your payment of this service. And that goes for this also, and that goes for veterans benefits, or any kind of benefit that the government provides. And we will take a deeper dive into this at the end of the video. We will look at a quick little interview regarding Weimar Germany, and it goes over the time period around World War I and World War II, and talks about what happened from an economic perspective, and it is very relevant to what we're experiencing today, and especially with these entitlement spendings, because we will see that the war reparations for Germany had a huge influence on the hyperinflation that they experienced. All right, and you can see here, this is a chart of U.S. goods and services. It's our trade balance from 1960 to 2016. I just wanted to show this really quick because we mentioned that this would be a way for the government to bring in more revenue. But as you can see, it is deeply negative. We are importing so many more goods and services than we are producing. And I thought this was a good chart to look at because it does mention NAFTA and the WTO, the World Trade Organization, and specifically when China joined it. We're not going to cover this specifically in this video because this is a whole different rabbit hole to dive down into, but this is something I am interested in putting a video out on. So if you'd like me to do that sooner than later, then just let me know down in the comments. All right, and I just really quickly wanted to show the distribution of annual household income in the United States, because we're going to be looking at several different kinds of taxes just to take a deeper dive into the perspective of why they really can't raise our taxes and why it would be such a political suicide for them to do something like that. So you can see over here the median household income was roughly about $50,000. The top 25% reported income greater than $85,000. The top 10% reported income greater than $135,000. But you can see that there's quite a bit of people who are actually making over $200,000 a year, and it makes up about 4% of households, but considerably more than any of the data really till you get back to under $100,000. So this median household income will be relevant for the next couple slides. So $50,000. All right, so this is our 2022 federal income tax bracket. And you can see this would be the majority of the population, Americans, are paying 22% just in income tax. And then if we come over here, income taxes on personal and business revenue and interest income. So that pretty much just explains what an income tax is. And then we also have payroll taxes from their workers' paychecks each pay period, and then they match the sums deducted. So they take money from your paycheck, but then they also require your employer to match the money they take from you. So that's your payroll tax. They also have capital gains taxes, and those are paid out on any profits made from the sale of an asset and are usually applied to home sales, stock, and bond transactions. The capital gains tax rate for 2021 is 0%, 15%, or 20%. Then you have taxes on property. So we have property tax, which is imposed on the value of real estate or other personal property. Then we have taxes on goods and services. The sales tax is most often used as a method for states and local governments to raise revenue. Purchases made at the retail level are assessed a percentage of the sales price of a particular item. Then you have the sneaky taxes down here. You have the excise taxes are based on the quantity of an item and not on its value. For example, the federal government imposes an excise tax of 18.4 cents on every gallon of gas purchased, regardless of the price charged by the seller. States often add an additional excise tax on each gallon of fuel. Then you have the user fees, are taxes that are assessed on a wide variety of services, including airline tickets, rental cars, toll roads, utilities, hotel rooms, licenses, financial transactions, and many others. Depending upon where someone lives, a cell phone, for example, may have as many as 6 separate user taxes, running up the monthly bill as much as 20%. And then there's so-called sin taxes, which are imposed on items like cigarettes and alcohol. For example, the cigarette tax in Connecticut and New York is $4.35 per pack, the highest in the nation. In Georgia, the same tax is 37 cents a pack. And then they have luxury taxes also, but that's not as relevant to the everyday person. They're imposed on certain items such as expensive cars or jewelry. So I guess that probably relevant for all you crypto people out there. All right, and if we come over here, this is an outstanding article that compares today to medieval times, and specifically regarding taxes. So yeah, here's the link. So I highlighted some key points. So Americans have no more claim to their incomes than did medieval serfs. The most successful Americans are comparable to slaves. And that sounds pretty crazy, but when you look at the numbers, it's pretty eye-opening. So a slave was worse off than a serf. A serf faced a maximum tax rate of 33%, but a slave was owned by another and had no claim to his own labor beyond subsistence. In the 19th century, this meant a tax rate of about 50%. Low-income Americans face a Social Security and Medicare tax rate of 15.3%, a federal income tax rate of 15%, federal excise taxes, state income and sales taxes, and local property taxes. The combined tax rate exceeds the burden borne by a medieval serf. Upper income Americans are exploited like 19th century slaves. The uncapped Medicare tax places the top federal income tax rate at 41.5%. Adding Social Security, excise, state income, sales tax, and property taxes produces a tax burden in excess of 50%. President Bush's tax cut merely raises Americans' successful class from slavery to serfdom. So you can see this is pretty dated, but at the same time, it is still very relevant, and the problem's only getting worse. So unfair tax laws that tax phantom income push the burden on the rich to 75% or 80% of their incomes. Because of the way capital gains taxes are levied on investments, this April, many investors will be taxed twice the statutory maximum despite the collapse in their value of investments. So you can see that we are already being taxed at the highest rate in just about all of recorded history. So this aspect makes it a political suicide just in itself, but we can also look at some relevant data that describes the economic situation for a lot of Americans today. All right, so you can see here, 1 in 3 households reported difficulties making ends meet in January, before the onset of the economic and health crises. So this was just before everything broke down in 2020. So some 40% of Americans said they couldn't cover a $400 unexpected bill without selling something or going into debt. And that was a 2018 Federal Reserve report that this was referring to. So this is very recent, just several years ago. So I think you can see that it's really not much of an option to ask Americans to pay more taxes. You know, this describes the lower and middle class, but even if you consider the rich, like the top 1%, how everyone's saying tax the rich, if we go back, they're paying over 75% of their income in tax. So at that rate, you know, there's a lot of different places in the world that would offer a better environment for that individual where they wouldn't have to pay 75% of their income to the government. Keep in mind that a lot of this money is going to entitlements and interest on debt. You know, a lot of it's just unproductive and doesn't produce more goods and services for future generations. So if you're paying 75% of your income to support something like that, that might turn a lot of people off. There's also an incentive for people to just leave America and find a place that treats them better. There's a saying, go where your money's treated best. And I think that's going to be the motto for a lot of these successful people going forward, unfortunately. So they can't get any more money really from tariffs. We're not producing really anything in America other than the US dollar. So our trade balance is not much of a balance anymore. It should be referred to as a trade deficit because that's what it is. And that's what it has been for decades on decades. And that just keeps getting more and more negative as time goes. We're definitely not bringing in any more revenue from that source. So taxes really aren't an option realistically. That is, if you want to get reelected and you don't want riots in the streets. So the last option that we talked about before was inflation, which is also a tax, but it is low-key and off the charts of many Americans that don't understand economics. So you can see here, public health research shows a link between high levels of inequality and social unrest and violence in communities. So the number one driver of inequality and the number one thing that puts pressure on low and middle income households in America is inflation. So they are choosing this route to go the inflationary route, but it's also going to cause a lot of inequality and social unrest along the way, as we can see from this. This is really what boils down to just about all the problems in the world. Money is the root of evil. It's also stored energy and very valuable when it is used in the right context. This is why I believe so strongly that we need to get back to a sound money system, and hence why I love Bitcoin so very much. So let's come over here, and this is a wonderful site if you guys have never been here before. It's called Shadow Stats. And this is specifically their inflation page. So you can see that this chart specifically shows both the CPI as it is measured today and the CPI as it was measured in the 1980s, because they have made many adjustments along the way to reduce the input to the CPI to try to suppress the levels. So as you can see, if it was measured the same way as it was in the 80s, it would be up at 15%. But as you can see, they are certainly taking the route of inflating the debt away. As you can see, we've had a pretty nice little spike right here. Pretty quick too. A lot faster than anything we've seen on this chart, except for maybe just after 2008. So we've established that we have a pretty serious problem and there's not really any good way out from this problem and not a good solution to solve it. And as we mentioned before, crisis is both chaos and opportunity. So how do we avoid the chaos and find the opportunities? I always like to look at history and see how things have played out historically in similar circumstances. So if we just look at inflation, we've had two major inflationary periods over the last 100 years. One was the 1970s, and the other was around the end of World War II in the 40s. But you can see that in the 1970s, debt to GDP was quite a bit smaller. We were under 50% from the beginning of 1970 to 1988. So if anyone knows anything about history or anything about the economic history regarding this time period, you've probably heard of a guy called Volcker. And he was the guy who came in and jacked interest rates up so high that it broke the back of inflation, quote unquote. This was only possible because you didn't have a government debt problem. They really let yields fly high, and it wasn't as similar of a circumstance as we are in today, even though it was just as inflationary as it was today. So let's take a step back in time and see if we can find a time period that's more similar to today. And if we scroll up, you can see here we start going up, and now we're 90s. We're over 100 right here. So as I was saying, around the time World War II ended was when we were over 100% debt to GDP. So when it comes to both the debt to GDP and the inflation, it was very similar to the time period around World War II and the Great Depression. So let's come over here to this image. And this chart is going to be the 10-year Treasury note real 10-year returns. So this gray line is going to represent the initial coupon rate, and this green line is going to represent the actual 10-year real annualized return. All right, so basically if you boil it down, it's just going to be your nominal yield on a 10-year versus your real yield on a 10-year. So if you see, like we were talking about in the 70s, there wasn't the debt problem that we had today. So you were able to allow the yield on treasuries to go up. As inflation was rising, so were the yield on the treasuries. So you can see that we actually did drop negative twice, but that was before 1970 in the late 60s and early 70s. But as the inflation continued, they were able to allow the yields to go higher. And as you can see, we actually had one of the highest rates of return on Treasury 10 years since 1900s. But if we go back to that time period we were talking about, around the 1940s, you can see that we had the Great Depression and then World War II. So the twin crises of this era actually took us deeply negative for over a decade right here. And as you notice from the nominal coupon rate, it was never allowed to get any higher. This whole time, the interest on the yields, the yields on the 10-year were getting continually more and more suppressed as time went on. And then finally coming out of that time period, they were able to gradually rise back into the 70s era where they just completely went through the roof. But during this time period, we were able to bring our debt to GDP down from about 120% to, I think it was 35% going into this time period, as we saw from the last webpage we were just on back there. So that's why I think this time period is going to be the most relevant to look at regarding trying to draw conclusions on how political figures might go about trying to solve the same problem that we find ourselves in today. And as you can see from this trading view chart that I put together, it just shows inflation and 10-year yields. So the orange is going to be 10-year yields, and the blue is going to be inflation. So you can see that inflation's went sky high over the last couple years, and we're up at 7% right now. It doesn't say it on this chart, but we're at 7%. And 10-year yields have not made the same move. We're not even recovered to where we were at in 2018. But we're probably more than double the inflation that we were at in 2018. Right now, or I guess we already did the math. We did the math earlier and figured out that the real rate of treasuries at the moment is about negative 5%. So you can already see that we have negative real rates of return that are even less than the time period of the Great Depression and World War II. Like, they are going all out with this agenda. So you might be thinking, why is it a problem that the government gets itself out of the debt problem that it's in, right? If you think about coming out of the Great Depression and World War II, we had 100 years of, rising asset prices. Everyone was pretty happy for the most part, the majority of it. So why would it be a bad thing? Well, you can see here, this is your purchasing power of the dollar, and it dates back all the way to the beginning of the 1900s. So $100 worth of purchasing power in 1900 is now down to $3. So you've lost 97% of your purchasing power since 1900. So you might be thinking, well, that's quite a long time. That's more than even a lifetime. So, all right, let's go back to just 1970. $20, right? Right here, down to $3. You've almost lost 90% of your purchasing power since 1970. Like, it's getting pretty ridiculous at the rate that you're losing purchasing power. And as you can see, that time period we were looking at was probably the fastest that anyone had lost purchasing power since this time period over here. So you can see that the delta of this move down was one of the fastest in history. The time period after World War II and the Great Depression, you lost purchasing power faster than any time in history. Your dollars were getting devalued faster than really any time. So as the government tries to get itself out of debt, they make all of us shoulder the burden by reducing the value of our money and in turn our stored energy that we've worked so hard to accumulate. That's why this is such a concerning problem. And it's a problem for everybody. All right, you can see here that as I was mentioning, that time period after World War II, you lost your purchasing power faster than any time in history, just about. So right here you can see that this isn't last month. This was regarding the time period when they were doing a whole bunch of printing after the March 2020 original crisis. So this was the quote from that time period, which was actually just a couple years ago, back in 2020. Last month, the US budget deficit, $864 billion, was larger than the total debt incurred from 1776 through the end of 1979. So that's over 200 years. We printed that amount in just 1 month in 2020. And we actually printed more in 2020 than all of recorded history, just in 2020 alone. It's ridiculous. It's crazy. And as I mentioned before, we're going to loop this back around to entitlements. So how does this relate to entitlements? The Social Security cost of a living adjustment for 2022 will be 5.9%. The annual increase will be the highest beneficiaries have ever seen in about 40 years. In 2021, the cost of living adjustment was just 1.3%. So people on Social Security are relying on the government to maintain their quality of life. If the government's going to be creating an economic atmosphere that's 7% inflation a year, that's really going to end up really hurting anyone that's on Social Security. So they have to increase the entitlement spending as they do inflation. So that means that they're just going to have to print more and more and more. That's why our entitlements are such a serious problem for the future of our country going forward. And as I mentioned, there's a really good little piece of information, a YouTube video that we can watch together really quick, and I can stop it and make some comments as we go along. It's going to be regarding the German hyperinflation history, and this is going to be talking about the war reparations and how Germany ultimately went through hyperinflation and ended up relying on Hitler to try to get them out of it. This is going to be the economic perspective story of Hitler and World War II. All right, so here's the recording. You can see the title is The German Hyperinflation History, and it's put out by a channel called The Economic Newbie, and it's a wonderful video. So with that, let's get started with it.
Armistice of 1918 and the subsequent Paris Peace Conference, culminating in the 1919 Treaty of Versailles, the First World War finally ended. With poetic serendipity, the treaty was signed exactly 5 years after the event which has initiated the global conflict, Archduke Ferdinand's assassination by a Serbian nationalist. The toppling dominoes of alliances and power shifts which had plunged much of the world into war on the side of either the Entente Allied forces or the Central Powers, including Germany, Austria-Hungary, and the Ottoman Empire, had finally achieved a fragile peace. This, however, came at a massive cost to Germany, which was made to accept guilt and responsibility for the war, significantly reduce its armed forces, and pay significant financial reparations to the countries against whom it had fought, mostly Britain, France, and Russia. Especially injurious to German.
All right, so just wanted to point out really quick that those war reparations were not paid out in German marks, so they were not accepting Germany's currency for those war reparations. As Germany could not afford to pay the high reparations, they would have to print more and more of their currency as it got devalued.
Especially injurious to German pride was the loss of the Lorraine-Alsace region to France and the occupation of the Rhine province called the Saar, which remained under League of Nations administration until 1935. In addition, much of the German fleet was scuttled and its air force was completely grounded. Many nationalist factions within Germany saw the signature of the Treaty of Versailles as a stab in the back to German pride, and the injury would not be forgotten. The financial reparations required by the treaty were deemed as excessively harsh by many Germans and even by some Allied commentators, such as the English economist John Maynard Keynes, who likened the settlement to the peace imposed on the Carthaginian Empire by the Roman Empire following the Second Punic War. The criticism was not just that the reparations required were excessively punitive, but that they might retard German recovery and thus breed ongoing resentment, and so it proved. 1918 to 1919, struggle for democracy. Following the war, a disgruntled working class began to revolt, alongside some portions of the German army, sparking the German Revolution. The German Emperor and Prussian King, Kaiser Wilhelm, despised by the proletariat, shocked by mutinies within his own army and fearful for his life, abdicated and fled to the Netherlands. This left a power vacuum, and on the 9th of November 1918, the German Chancellor, Prince Max of Baden, also abdicated, handing the reins over to the Socialist Democratic Party leader, Friedrich Ebert, and his Secretary of State, Philipp Scheidmann. The latter promptly declared Germany a republic, and 2 hours later the left-wing Socialist Spartacus League declared a Free Socialist Republic. In order to quell further division, Ebert hastily assembled a coalition called the Council of the People's Deputies, together with the independent socialist leader Hugo Haas. The council instituted a series of broadly progressive reforms, including national health insurance, social welfare reform, and greater powers for workers to organize themselves into labor unions. Further conflict between the various political factions in Germany, in which there were 29 recognized parties at one point, leading to strife in Berlin, where the Russian Revolution admiring Spartacus League attempting to impose communist rule. This uprising was put down in armed conflict between the communists and paramilitary Freikorps, volunteer soldiers who were anti-communist. The two Spartacus League leaders, Rosa Luxemburg and Karl Liebknecht, were assassinated during the fighting. Their killers were treated with undue leniency, according to radical leftists. This and other conflicts in Bavaria led to an increasing division in German politics between...
All right, so I just wanted to pause it there one more time. I'm going to try to limit the amount that I pause it, just because the video is being pretty slow at the moment. So just wanted to pause it here and mention that, as you can see from the German situation going through something similar to what we're experiencing today, there was a lot of political tension before World War II happened. Everyone knew there was a serious problem, it's just no one really knew the right solution to get out of the problem. And that's a very similar emotion to what we are experiencing as a society today. And I just want to point out one more time that our entitlement spending is something that we cannot print, just as the Germans couldn't print other currencies to pay war reparations. We can't print medical services or Social Security. We have to print the dollars to pay for the services. And those services go up in price as the currency gets devalued. And that's why we're in a similar situation as to what Germany was facing after World War I. We've basically promised to pay a lot of money that we don't have, and we don't really have a good way of saying that we can't pay that money anymore.
This and other conflicts in Bavaria led to an increasing division in German politics between communists and social left-wingers and conservative or far-right nationalists, including among others the National Socialist or Nazi Party. Eventually, National Assembly elections were held, and a coalition government assembled in Weimar, giving the republic its unofficial name. 1920 to 1923, reparations and hyperinflation. The reparations agreed in the Treaty of Versailles amounted to 132 billion marks, a significant debt for a country that was also seeing its territories diminished and valued industrial and agricultural regions lost to the Allied countries. Although the terms of the agreement specified that monetary reparations could be paid back over time and should be made in gold-backed or foreign currency rather than paper Deutschmarks, the Weimar Republic began to respond to growing economic uncertainty by printing increased quantities of marks rather than by borrowing from other countries' banks. This resulted in the progressive devaluation of the currency and eventually in an exponential collapse of currency value known as hyperinflation. The precise causes of the spiraling devaluation of the mark between 1919 and 1923 are much debated. What is agreed is that Germany was economically straitjacketed from all sides. Germany found itself unable to import more than a severely restricted...
So I just wanted to pause it one more time, really quick, to mention that the hyperinflation was absolutely terrible. So the gold-backed mark compared to just a normal paper mark, the Deutschmark that he mentioned before, it was 100 Deutschmarks for one gold-backed mark, and by the next year it was 1 trillion Deutschmarks for one gold-backed mark. So that's pretty much comparing the Deutschmark, the paper mark, to an ounce of gold. So in 1 year, it went from 100 marks, paper marks, to 1 trillion. So the hyperinflation in Germany was incredibly bad.
Germany found itself unable to import more than a severely restricted selection of goods, which ordinary Germans could not afford, while its agricultural production was massively reduced. In addition, the country had existing debt from war expenditures and now added reparation costs, producing huge political instability. Workers were striking for pay and improved conditions, creating further economic pressure and civil unrest. Seeking a quick solution, the government simply printed more money to pay off the strikers. Flooding the markets with extra banknotes quickly caused prices to rise, as well as allowing unscrupulous borrowers to write off impossible-to-pay debts. In January 1923, a loaf of bread cost 250 marks. By November, the price had risen to 100,000 million marks. Workers were transporting wage payments home in wheelbarrows. Photographs from this period show children playing with building blocks made from banknotes and homeowners satirically papering their walls with worthless marks. Factory workers would be paid twice daily, since by the afternoon, their morning wages would be considerably devalued. Eventually, it cost more to print a banknote than the note was worth. By the end of summer, single banknotes worth 50 trillion marks were being printed. A solution was desperately needed, and it came later that year in the form of a highly fortuitous political appointment. 1923 to 1924, Reichsmarks, Hitler, and the Dawes Plan. In August 1923, President Ebert appointed Gustav Stresemann as Chancellor and Foreign Secretary. He stepped down from the former position after just 102 days, but remarkably managed to arrest hyperinflation and restore a modicum of economic stability within that period. He remained Foreign Secretary until his death in 1929. Stresemann's big innovation was to redenominate the currency, creating the Rentenmark, who later became the Reichsmark. The exchange rate, when the new currency was instituted, valued one Rentenmark as equivalent to 1 trillion paper marks. Unlike the paper marks, the new currency would be heavily restricted in terms of how many notes could be printed and pegged to the pre-inflationary value of the dollar, $1 equal to 4.2 Rentenmarks. Worthless marks of the old currency were handed over by the ton, pulped and recycled as paper. Stresemann, like many other Germans, saw the penury inflicted upon Germany under the Treaty of Versailles as unfair and untenable. Nevertheless, he recognized the importance of making good on reparation promises and knew that there would be valuable diplomatic gains to be had, which would further assist his country's recovery. During his 3 months as Chancellor, Stresemann managed to end hyperinflation with his new currency and by other means, including negotiating a reduction of reparation payments to $50 million per year, agreeing to borrow millions of dollars from U.S. banks to help fund German businesses and economic recovery in called Dawes Plan, successfully negotiating withdrawal of Allied occupying forces from the Ruhr Valley, negotiating the return of key German territories from Belgium in return for an agreement to resume reparation payments. Although these measures aggrieved some German citizens on both ends of the political spectrum, they brought about the second age of the Weimar Republic, which was a 5-year period of remarkable stability alongside enhanced social and cultural freedom. During this period, German industrial output doubled between 1924 and 1928, and income from taxation increased and the Allies were mollified. For his efforts, Gustav Stresemann was awarded the 1926 Nobel Peace Prize. During this period, resentments on the far right led to an attempted power grab by the leader of the National Socialists, Adolf Hitler. Hitler was drawing upon ordinary people's belief that Germany had been betrayed by its leadership into accepting the harsher conditions imposed by the Treaty of Versailles. He claimed that Germany was now in hock to a cabal of Jewish and Jewish-American bankers and whipped up anti-Semitic and nationalist fervor, culminating in an attempted coup, the Beer Hall Putsch, in Munich in 1924. The coup failed and Hitler and some of his followers were arrested. Hitler was sentenced to 5 years in prison but served only 8 months. During his incarceration, he wrote his best-selling manifesto/autobiography, Mein Kampf, in English, My Struggle, and plotted a future rise to power through more mainstream political means.
Alright, thought I would stop the video there. I think we did a pretty good job of going over the economic situation that led into World War II for Germany. And it did show a little bit about what was going on with Hitler. So if you guys want to watch the rest of that video, you guys saw the title and the link and everything, so feel free to look it up. I think there's only about 4 more minutes, but I just wanted to really show the economic similarities to what Germany went through and what we are finding ourselves in today also. And specifically the situation of having a problem where you owe money that you can't print. So in our situation, it's entitlements, such as healthcare or social security. In Germany's situation, it was war reparations. But I wanted to come back to this chart because I thought it was really important. So World War I ended in 1918, and that's when the war reparations begun. So you can see that it really didn't have a huge effect at the beginning. From the beginning, the first year right here, 1918, you really didn't see much inflation. 1919, a little bit more, and then it really peaked out in 1920. And then after it peaked, it had a good 2 years of consolidation from 1920 to 1921. And then from 1922 to the end of 1923 is where you saw an incredible amount of inflation. The delta picked up about midway through 1922, but you can see at the beginning of 1923, it was just a straight line up. You went from 10,000 paper marks for one gold mark, which is just a mark that's backed by an ounce of gold. So it's basically comparing to an ounce of gold. So you can just see in less than a year, went from 10,000 to a trillion. But even from 1922 to 1923, you went from somewhere around 100 to up there around 10,000. It takes several years to see the effect of this problem, but as you draw to the conclusion of the problem, that's when things really start to become problematic. That's why I find this to be such a fascinating topic to continue watching and following. And this is also a great reason to look into Bitcoin and cryptocurrency. Bitcoin is sound money. It is pretty early on in development, but it was designed to be a store of value, and I believe it has already proven that on long time period scales, because if you hold it for 5 years at a time, no one that's ever held Bitcoin for more than 5 years has probably ever lost money due to the cycles and all of that. And I think as more liquidity comes into Bitcoin and the cryptocurrency market, the more Bitcoin is actually going to become a real macro store of value. As more liquidity flows into the market, that's going to mean less volatility. You have to keep in mind that gold is over 10 times the market cap of Bitcoin. So naturally, it should just have that much less volatility. And even with such a high market cap, gold is known to make big moves in short amount of times. So to bring it back to our thesis and what we think is going to happen to the economy over the next 5 to 10 years, you can see that Germany had to print a lot of money. And as they did so, the price of assets went up. But you can see that along that road, there were plenty of times where you did have some bumps in the road. So I believe this is going to be our big picture, or maybe not this. I don't think nothing like this is going to happen in the United States as far as the information that I have right now suggests. Maybe that changes in the future. I don't think it will at the moment, but I think we're going to have to do some serious inflating though. This is just an extreme example of inflation. As we get more inflation, that really does provide an environment for asset prices to go up as the currency becomes devalued. So stocks can be very situational when it comes to inflation. So you really want to look for scarce assets. And as you can see, this was gold. And gold is a scarce asset. So something like Bitcoin theoretically would be a very good asset to be holding over the next 10 years. And if you consider how well Bitcoin performs compared to gold, you can only imagine what the possibilities are for Bitcoin going forward. And as Bitcoin does better, it usually brings the whole crypto market with it. And I think the rest of the crypto market, each individual sector and industry within crypto, all has great things going for it. But if you have Bitcoin in such a bullish scenario, that can only mean great things for the whole space. But like I said, there's going to be bumps in the road, and I think we're actually going through one right now. Right now, the Fed wants to taper, it wants to raise interest rates, and it wants to reduce its balance sheet. At the same time, the government wants to reduce its debt to GDP, and it doesn't want to default on its obligations. There's a lot of political pressure that's associated with inflation, and I believe that's why the Biden administration is trying to fight inflation at the moment, because his ratings are just dropping very quickly. But we all know at this point, after watching this video, that as they try to fight the inflation, they're going to end up actually crashing the economy in the other way. On military spending, because then another world power would take over. And we can't cut back on entitlement spending because a big portion of that, the biggest portion actually, is Social Security spending. And the baby boomer generation is the largest generation in history. So you'd really be screwing the majority of people. So when it comes down to it, I don't think they're going to be able to make it too far into what they're trying to accomplish with raising interest rates, reducing the balance sheet, and tapering. They also have the situation that the SLR exemptions did expire. So as they reduce purchases of treasuries, there's not going to be the liquidity needed to actually suppress the yields, which means the yields are more likely to actually go quite a bit higher. So I will be watching very carefully to see how they go about doing what they're trying to accomplish right now. But I think ultimately they're going to fail in their attempt to actually raise interest rates considerably, reduce their balance sheet, considerably, or even at all, and maybe even get through tapering, I think that's more likely that they do get through tapering, but, I think there's a chance that they might not even make it through that. Or if they don't make it through it, they would do some kind of twist where they make some kind of special circumstance where they don't taper one sort of asset, like maybe the long end of the curve. So I think we'll wrap up the video. I think we did a pretty good job of going over the basics. We also looked at quite a bit of data that was pretty relevant to what we were talking about. And I think we did a pretty good job of relating it back to our thesis and what we expect from the markets over the next 5 to 10 years. So with that, I think we will wrap up the video. All right, everyone, thanks for watching. We hope you all found this content valuable. If you did, like this video to let us know so we can continue to put out similar content. If you have any questions or comments, or if you have any suggestions regarding other topics you're focused on and would like to see us cover, just let us know in the comments below. And subscribe to our channel to become a part of the most comprehensive upcoming communities on all of YouTube. This economic environment only comes around once in a lifetime, and we're here to act like it. We're not here to talk you up. We're going to leave our emotions at the door and navigate these markets through the good and the bad. Keep in mind that this is not financial advice. This is more of a mastermind that we can all come together as a community and use each other's unique perspectives to better achieve logical conclusions. We really appreciate all of our team out there watching, and we look forward to continuing conquering these markets with y'all going forward. Until next time, stay one move ahead. Have a great day, everyone.